Thanks for tuning in to your daily dose of quick real estate updates, local housing trends, and market data, plus tips, tools, and strategies to help you buy, rent, or invest with confidence. You're now getting ready with RealiCare Reports, powered by the innovation team, Cami and Rex. Now go grab your favorite morning breakfast, coffee or tea, and let's enjoy today's episode.
If you live in New Orleans right now and buy a house today, you are essentially volunteering to set over $3 million on fire.
Yeah, pretty much.
Which is wild. So welcome to the deep dive. Today, we are completely tearing up that traditional outdated advice that, renting is just throwing your money away. Or, on the flip side, that homeownership is some guaranteed financial trap.
Right, because the reality of the housing market in 2026 has it's completely shattered those absolute rules.
Totally.
We're dealing with this environment where your financial outcome depends on this really volatile mix of local zoning, climate risks, interest rates, and honestly, your own psychological discipline.
Yeah, that psychological piece is huge.
It is. And to understand what actually builds wealth today, we have to look way past the monthly payment. We need to examine the underlying mechanisms of how money actually compounds in real estate versus, say, the stock market.
Okay, let's unpack this.
Yeah.
Because our mission today is to cut through all the extreme noise out there using some brand new 2026 data from Zillow research. And look, the goal isn't to declare a universal winner for everyone.
No, not at all.
We want to figure out exactly where and when buying actually pays off for you under today's very specific market conditions, and where renting is secretly the best financial move you could possibly make.
Exactly. And to map out those specific quirks, we first have to establish the national baseline.
Right.
I mean, we really need to know what the average mathematical reality looks like before we can even start to understand the wild geographical extremes.
Well, I've got the national picture right here from Zillow report. So currently, the typical U.S. home value for a single-family home is sitting at $368,720.
Okay.
Meanwhile, the typical rent is $1,951 a month, and the crucial third variable here is the cost of borrowing. So 30-year fixed-rate mortgages are hovering just slightly above 6% right now.
Right, and those three numbers interact to create this massive upfront hurdle for buyers.
Oh, absolutely.
Month to month, at the very beginning of the timeline, buying almost always costs more. You've got the mortgage, the property taxes, the homeowner's insurance, and, the immediate maintenance costs.
Which is exactly why renting feels so appealing at first glance.
Yeah, it feels safer.
Right. Renting is basically a monthly subscription model. You pay your fee, and you keep your leftover capital completely liquid.
Exactly.
You can invest it in stocks, you can put it in a high-yield savings account, or, you can just pivot if you lose your job.
Mm-hmm.
Buying, by contrast, feels like a forced savings account, but with this massive, heavy upfront entrance fee that just ties up all your liquidity.
Yeah, and that subscription model of renting absolutely maximizes your liquid cash on hand in year one. But the Zillow data actually models what happens when we stretch this exact scenario out over a full 30-year horizon.
Okay, and what happens?
The divergence between the two paths is just staggering. A buyer who puts 20% down on that typical $368,000 home ends up with roughly $735,000 in net housing wealth after 3 decades.
Let's define net housing wealth for a second, so we aren't just, throwing big numbers around.
Good idea.
Because we aren't just talking about the home's final value. We're talking about the forced payoff of the loan principal combined with historical appreciation, minus everything the buyer bled out in mortgage interest, taxes, and maintenance over those 30 years.
Right, it's the true net gain.
Okay, so the buyer is up $735,000. How does the renter fare over that exact same 30-year period?
A renter ends up at roughly a negative $1.15 million net position.
Wait, a deficit of over $1 million.
Yeah.
That is nearly a $2 million gap between the choices. But wait, I have to push back on that negative 1.15 million figure.
Let's go for it.
How does the renter end up in the negative millions if the whole point of that subscription model is that they are keeping their cash liquid and actively investing it?
Well, what's fascinating here is how the compounding math actually breaks down for the renter. That negative 1.15 million assumes the renter makes incredibly disciplined financial choices. The model dictates that the renter takes their untouched down payment money, plus any cash they save in the months when renting is cheaper than owning, and they invest it continuously.
Right.
And from those investments, the renter actually gains about $313,000 in market returns.
So they successfully hit the market, they make over 300 grand, and they still end up in $1 million hole.
Yeah, because those investment returns are fighting a totally losing battle against the compounding cost of shelter.
Oh, I see.
Over those 30 years, our renter pays about $1.47 million in rent and renter's insurance, because rent typically inflates by 3 to 5% annually.
Right. It never stays flat.
Exactly. So you take the $313,000 they gain from investing, you subtract the $1.47 million they spent on an inflating monthly rent, and you are left with that negative $1.15 million net position.
Wow.
The sheer compounding weight of 30 years of rent just completely swallows the stock market gains.
That is wild. So the forced savings account with the heavy entrance fee absolutely crushes the liquid subscription model over a 30-year timeline.
It really does.
The sheer cost of just existing inside a building for 3 decades wipes out the benefit of staying liquid.
Which means we have to really discard the most common misconception in personal finance, which is that a higher monthly cost at the start means buying is the worst financial choice.
But surviving that 30-year gauntlet to get the $735,000 payoff depends heavily on, paying that initial entrance fee.
Right.
Which brings us to the timeline. Because if you know buying wins long term, you want to reach the break-even point as fast as possible.
Yeah.
That exact month where the financial benefits of buying finally overtake the benefits of renting.
Right. You don't magically accrue that wealth on day one. You have to earn it over time by staying put and really just letting the amortization schedule do its work.
Well, here's where it gets really interesting.
Okay.
Because the traditional ironclad wisdom passed down by every single financial guru is to always put 20% down.
Oh, always.
It's treated as this universal law to avoid private mortgage insurance and keep your monthly payment low. Yet the Zillow data shows that putting only 5% down actually breaks even faster in several major U.S. markets.
Yeah. If we connect this to the bigger picture, we have to analyze this really delicate trade-off between upfront liquidity and ongoing borrowing costs.
Right.
Because putting only 5% down guarantees a larger loan, higher interest payments, and the added drag of mortgage insurance.
So the monthly bleed is much higher. Why in the world would that break even faster?
Because of the massive opportunity cost of waiting.
Oh.
In markets where rent prices are very high and home values are consistently appreciating, trying to save a massive 20% lump sum is just a losing race.
Because it takes years.
Exactly. If you wait 4 years to save that 20%, you are paying sky-high rent that entire time. And worse, you're chasing a moving target.
Right, because the house isn't the same price anymore.
Right. The home that costs $400,000 today might be $460,000 by the time you actually save the down payment.
So you are basically missing out on years of the asset appreciating without you.
Yes. A smaller down payment lowers that upfront hurdle. It allows you to buy the house today, lock in your purchase price, and start capturing that property appreciation immediately. You basically transition from paying a landlord's mortgage to paying your own much sooner. Now, it is crucial to note that while 5% down gets you to the break-even point faster in these specific markets, the 20% down payment still produces the strongest total wealth by year 30.
Because eventually, over 3 decades, the heavy burden of the larger loan and the extra interest drags down your overall net worth.
Right.
So the 20% rule still wins the marathon, but the 5% rule can totally win the sprint to the break-even line.
That is the exact mathematical trade-off.
Yeah.
The larger down payment raises the hurdle at the start, but significantly lowers the carrying cost of the home decade after decade.
And because this down payment paradox relies entirely on the local ratio between rent prices and home prices, we have to map this out geographically. Because the national average is really just a theory. Real estate happens on a specific street in a specific city.
Oh, for sure. And the list of the fastest places to break even completely defies all the usual assumptions about where real estate is booming.
It really does. So the surprise winners for buyers, the top 5 fastest break-even markets among the 50 largest metros are Columbus, Memphis, Buffalo, Indianapolis, and Cincinnati.
Right, a lot of Midwest in there.
Yeah. Let's look at Columbus. It is the absolute fastest market in the country right now for buyers. Buying a home there with a 5% down payment breaks even in just 3.5 years.
Wow.
But if you try to follow the traditional advice and put 20% down in Columbus, it actually takes 4.1 years to break even.
Yeah, Columbus perfectly illustrates the mechanism of that lower upfront hurdle. Rents in Columbus are relatively high compared to the actual purchase price of a home, and the property values are appreciating rapidly. So if you wait to save the 20% there, the market outruns you. Lowering the barrier to entry is just the optimal strategy for speed in the Midwest right now.
But let's look at a market where the old rules still apply. Let's look at Chicago.
Ah, Chicago. In Chicago, the math flips entirely back to tradition. A 20% down payment breaks even faster than a 5% down payment, and it builds far more long-term wealth.
So what specific variable makes Chicago behave so differently from Columbus?
It's the sheer weight of the carrying costs.
Oh, the taxes.
Exactly. Illinois has some of the highest property taxes in the entire nation. When you combine those massive property tax bills with the higher borrowing costs of a larger 5% down loan, the monthly financial bleed is immense.
Wow.
Yeah. In Chicago, the carrying costs are so heavy that minimizing the loan size with a 20% down payment is literally the only way to effectively outpace the cost of renting.
That makes total sense.
The savings you get from borrowing less money matters significantly more than the benefit of getting into the market a year or two earlier.
Okay, so we have the lightning fast Midwest markets and the heavy carrying cost traditional markets. Let's return to the hook of this entire discussion.
Okay.
Where does the data point and explicitly say buying a house here is a terrible financial decision?
We are looking at San Francisco, San Jose, and New Orleans.
Okay.
In these specific metros, today's prices, interest rates, and local risks leave renting ahead of buying even over a full 30-year horizon.
I am looking at the New Orleans data, and it says a renter beats a buyer by $3.39 million over 30 years.
That's crazy.
I have to push back here. How is a $3 million gap even mathematically possible unless the houses are literally sinking into the swamp?
Well, it comes down to a catastrophic combination of stagnant appreciation and skyrocketing carrying costs.
Okay.
New Orleans is currently facing a severe climate risk profile that has completely destabilized the local insurance market.
Right. The insurance crisis.
Exactly. Yeah. Homeowners are seeing their insurance premiums double or triple while property taxes remain high. And simultaneously, because of those very costs, the actual value of the homes isn't appreciating fast enough to offset the monthly bleed.
So a massive portion of the homeowner's monthly payment in New Orleans is just dead money going to insurance premiums, not building equity.
The carrying costs completely outpace the equity accumulation. In New Orleans, assuming a full 20% down payment in a 30-year timeline, the renter wins by $3.39 million.
That's unbelievable.
In San Jose, the renter wins by about $1.89 million because the raw purchase prices are so astronomically detached from local rents.
Right.
And in San Francisco, the renter wins by $583,000.
That completely shatters the myth that a house is always a brilliant investment. If you live in those cities, buying a home is a luxury consumption choice. It is not a wealth-building strategy.
It is a lifestyle choice with a massive negative yield. And there is a secondary tier of cities where buying eventually does pull ahead, but it demands extreme generational patience.
Like where?
Metros like San Diego, Seattle, Austin, Los Angeles, and Portland.
In those cities, how long are we talking to reach the break-even point?
Under current conditions, it takes roughly 17 to 25 years just for the buyer to break even with the renter.
25 years. You would have to close on the house the day your child is born, and you wouldn't technically be in the green until they are off your payroll and finishing graduate school.
Right.
You cannot buy a home in Seattle expecting to flip it or even be financially ahead in 5 years.
No, it requires an ironclad commitment to staying put.
So we've laid out the pure mathematical timelines, the national averages, the high-speed Midwest, the brutal coastal markets. But we have to address the giant glaring blind spots in these formulas. Spreadsheets assume human beings act like perfectly rational algorithms, and humans are notoriously messy with money.
Yeah, financial models demand discipline. Human behavior guarantees friction.
Exactly. Let me bring up the biggest behavioral flaw in the renter's mathematical model.
Let's hear it.
The Zillow data assumes the renter takes their unspent down payment plus the money they save every month by renting and diligently invests it in the market.
Right.
I call this the gym membership assumption. The renter's financial model assumes they hit the financial gym every single day, putting leftover cash into index funds and never touching it.
Which rarely happens.
Right. In reality, if you're renting and you suddenly have an extra $500 because you aren't paying to fix a broken water heater, do you really open your brokerage account? Or do you upgrade your car or book a flight to Tulum?
The gym analogy is fair for human behavior on the renter's side, but you are giving buyers way too much credit here.
Oh, you think so?
Absolutely. Buyers are not immune to lifestyle creep. The argument is usually that a mortgage is a forced savings account that prevents you from spending the money on vacations.
Right.
But let's look at how homeowners actually behave. When home values spike, homeowners routinely take out home equity lines of credit.
Oh, the ALOCs?
Yep. They use their home as an ATM to fund those exact same vacations, or to rip out a perfectly functional kitchen because they suddenly feel equity rich.
So they pull the equity right back out and completely reset their amortization schedule.
They absolutely do. So while the renter might fail to invest their savings, the homeowner frequently cannibalizes their own forced savings account to fund lifestyle upgrades. Neither side is perfectly disciplined.
Okay, that completely neutralizes the forced savings superiority argument. But let's look at a structural advantage that doesn't rely on human discipline.
Okay.
What about the institutional advantage? The entire federal tax code is basically written to subsidize homeownership.
Well, this raises an important question about how we calculate real-world returns. But the tax argument requires a major update for the 2026 reality.
How so?
We always hear about the holy grail of the mortgage interest deduction. People talk about it like it's this magic wand that slashes your tax bill.
Because especially in the early years of a 30-year loan, almost your entire payment is just interest going straight to the bank.
Right. But let's be real with the audience here. Since the standard deduction was massively raised a few years ago, a huge chunk of everyday, middle-class home buyers do not even itemize their taxes anymore.
Oh, wow. I didn't think about that.
Taking the standard deduction is often just more beneficial than itemizing the mortgage interest. So for millions of average buyers, that specific tax benefit is completely irrelevant.
They don't see a single dime of tax relief from their monthly mortgage payment. So where does the tax code actually help them?
The real unseen superpower of the U.S. tax code for homeowners is the capital gains exclusion.
Ah, okay.
When you eventually sell your primary residence, if you meet the residency requirements, you can often exclude a massive portion of the profit from capital gains taxes.
Really? How much?
Up to $250,000 for a single filer, or $500,000 for a married couple.
That is huge. So if a renter makes $500,000 in the stock market, they are paying a massive capital gains tax bill when they sell those shares.
Exactly.
But a homeowner can walk away with $500,000 in tax-free profit.
Yes. Renters get absolutely zero tax shelter for their wealth building. If you factor in the capital gains exclusion on the sale of a property, the long-term math for buying looks substantially stronger than the raw Zillow baseline even suggests.
So the tax code eventually rewards the buyer, assuming they hold the property long enough to see hundreds of thousands in appreciation.
Right.
But, you know, I think we're missing the most fundamental mechanism of why real estate works as a wealth builder.
Yeah.
A house is not a stock ticker. It is fundamentally shelter.
It is the largest line item in the average American's budget. And this really reveals the dual benefit of owning a home. When rents and home values rise quickly across the economy, the homeowner benefits twice. First, they own an asset that is actively compounding in value. Second, they are largely insulated from future housing inflation.
Because they have locked in the cost of their shelter.
Exactly. Their principal and interest payments are fixed for 30 years. It acts as an incredibly powerful hedge against inflation. Even if property taxes and insurance go up, the bulk of their monthly housing expense remains frozen in time.
Right.
Renters, on the other hand, do not get the appreciation of an asset, and they remain entirely exposed to market forces. Every single time their lease comes up for renewal, they have to negotiate against prevailing inflation.
Yeah. In a market where everything is getting more expensive, capping your biggest monthly expense is a massive compounding financial advantage.
It really is the ultimate defensive financial maneuver.
So what does this all mean? We have covered a tremendous amount of ground navigating these 2026 numbers.
We sure have.
We've gone from the raw math to tax policy to inflation hedging. Let's sort of summarize the key takeaways so the listener can actually apply this to their own life.
I would boil the data down to this. Nationally, the math indicates that buying still works as a primary wealth-building tool, but it requires serious staying power. On average, across the entire country, you need to expect to stay put for around 6 years just to break even against a renter.
So 6 years is the national baseline to clear the entrance fee.
But the real answer to is buying a good idea for you depends almost entirely on your specific zip code, how much cash you put down, and honestly, your self-awareness regarding your own spending habits.
Yeah, that behavioral piece.
Exactly. If you live in Columbus, getting your foot in the door with 5% down is a brilliant strategy to capture rapid appreciation.
Hmm.
But if you live in New Orleans or San Jose, renting is overwhelmingly the superior financial move, and buying is really just an emotional luxury.
And for you listening right now, it is vital to remember that these numbers from Zillow are a disciplined framework. They are not a universal law for your life.
No, not at all.
You have to look at your local carrying costs, your career mobility, and your financial discipline. If you know you aren't going to invest the difference when renting, the math completely changes.
It does.
If you know you're the type to treat home equity like a personal ATM for vacations, the math changes again.
It really requires an uncomfortable level of deep self-honesty about your financial reality.
It does. But before we wrap up, I want to leave you with a completely different angle to chew on. Something that the spreadsheets, the Zillow data models, and the tax codes completely fail to capture.
Oh, was that?
We have talked extensively about the financial cost of maintenance. The math knows exactly how much a new roof or a water heater costs over 30 years. But what about the psychological cost of maintenance?
The invisible mental burden of physical ownership.
Exactly. What is the actual tangible mental value of flexibility? The data tells us that a homeowner in a good market might build $1 million more in net wealth over 30 years than a disciplined renter.
Right.
But is that $1 million wealth gap worth the sheer unadulterated anxiety of waking up to a flooded basement on a Sunday morning?
That is such a good point. The psychological load of being the single entity responsible for the physical integrity of a structure is immense.
Yeah.
When you own the home, every storm, every weird noise in the plumbing, every drafty window is your personal financial liability.
When you rent, a burst pipe is just a minor inconvenience. It's a free phone call to a landlord, and then you just go back to sleep.
Right.
But when you own, a burst pipe is a logistical nightmare. It's calling contractors, filing insurance claims, managing repairs, and taking a massive, unexpected hit to your cash flow that can ruin your entire month.
You really have to ponder whether peace of mind has a hidden price tag. Is the psychological flexibility, the absolute lack of structural responsibility that comes with renting, worth giving up the long-term wealth accumulation of buying?
Which brings us right back to the beginning. We all want the math to give us a clean, easy, clinical diagnosis. We want the spreadsheet to say broken or not broken, buy or rent. But the reality is that the financial landscape is incredibly murky. The right choice depends just as much on your zip code's property taxes as it does on your personal tolerance for handling a flooded basement.
Real estate is the ultimate collision of complex financial modeling and raw human emotion.
It really is. Something to think about the next time you're endlessly scrolling through real estate listings late at night or, staring down a lease renewal. Keep your head on a swivel, check the specific carrying costs for your city, and we'll catch you on the next deep dive.
Well, that wraps up today's episode of Reality Reports, where real estate meets real life. For more updates, tools, and insights that will help you buy, rent, or invest with confidence, be sure to follow, subscribe, stay connected, stay informed, and stay ready. Until next time.